in 5 simple, fast steps. And at the end of the video, I'm going to tell you whether or not I think you should buy index funds. Step number 1, let's understand how this works and how an ETF is actually created and traded on the stock market. In this video, I'm going to use these terms, ETF and index funds, synonymously. I know they're a little bit different, but just to keep things easy, we'll go with an ETF. Farmland, 4 pieces of property. One produces wheat, cotton, corn, and weeds. And trust me, that'll make sense here in a moment. So the ETF comes in and they buy up all this property, they get the title, so they actually own these pieces of farmland. And then they issue all of these shares which represent equity in the ETF, not necessarily the underlying asset, but in the ETF itself. Those shares go into the stock market, and all these people who are in the marketplace that are either bearish or bullish on farmland, but really don't want to get their hands dirty and buy or sell the actual farmland itself, they'll go into the market and trade the shares of the ETF. There could be millions of shares going back and forth on a daily basis between buyers and sellers without the ownership of the actual farmland changing at all. Step number 2, Michael Burry starts his argument with there is no more price discovery in the market, and this has created a huge bubble in ETFs and index funds. To understand this further, let's look at specific quotes from Burry in Bloomberg. And now, passive investing has removed price discovery. Index funds and ETFs do not require the security level analysis, in other words, fundamental analysis, that is required for true price discovery. Going back to our example of the farmland, we have 3 new participants. The manager of the ETF, ETF Eddie. The old school farmer that really knows his stuff, Farmer Joe. And the newbie who really doesn't know what's going on, Farmer Fred. Farmer Joe bases his analysis on what he is willing to pay for each one of these properties on the fundamentals. Meaning, he looks at this piece of property that grows wheat and he says, how much money could I make if I grow wheat on that property? He comes to the conclusion that he could pay about $1,000 for that piece of property and still make money. For cotton, $1,200, corn, $900, and for this property that just grows weeds, only about $500. ETF Eddie doesn't care about the fundamentals at all. Who cares about fundamentals? I only need to buy these pieces of property so my ETF and the shares of my ETF reflect the price of farmland. So he drives all this liquidity into the market and just buy at any price. Well, Farmer Joe looks at that and he says, that's crazy. I'm not going to pay all those high prices that ETF Eddie is willing to pay. So he checks out. ETF Eddie creates so much artificial demand for farmland that the prices actually double. Farmer Fred looks at this and he doesn't have the experience of old Farmer Joe. He thinks that the prices are going up based on the fundamentals. So he looks at this piece of property that only grows weeds and says, wow, that doesn't look too bad. That actually looks like a good deal. And I don't think there's that much risk with this property because it's already priced at $1,000. And if it was really risky, it would be $500. Are you connecting the dots? That is the price discovery that Michael Burry is referring to. So Farmer Fred goes to Eddie. He says, Eddie, I will buy your property for $1,100. And Eddie says, sure, no problem. Sold. Fred ends up buying a property that's way overpriced for what his use case is, meaning that he bought into a bubble that was created by ETF Eddie driving all of that liquidity into the market. And it doesn't matter whether we're talking about farmland, the S&P 500, the NASDAQ, the Russell. These principles hold true regardless. The bottom line is the prices and the market is no longer a reflection of the fundamentals. It's only a reflection of liquidity. Step number 3, Michael Burry's next concern is that there is no liquidity. Let's go back to the Bloomberg article. The dirty secret of passive index funds, whether open-end, close-end, or ETF, is the distribution of daily dollar value traded among the securities within the indexes they mimic. In other words, if the trading volume of the underlying asset is extremely low relative to the index, there could be big problems. In a panic selling situation, Burry uses the example of a movie theater. The theater keeps getting more and more crowded, but the exit door is the same as it always was. All this gets worse as you get into even less liquid equity and bond markets globally. We're going to add another participant to the mix. He's a market maker. We're going to call him Market Maker Mike. A lot of times the price of the ETF can get slightly skewed from the underlying asset because the underlying asset is traded in the primary market. That means going from farmer to farmer. But the secondary market trades the shares of the ETF. A lot of times the demand can be high, maybe sometimes not so high. So there can be price discrepancies between the two markets. That's when market maker Mike steps in, and if the price is too high over here, he'll buy in the primary market and sell in the secondary market, pocket the spread. On the flip side of the coin, if the price is too low in the secondary market, he will buy here and sell in the primary market and then pocket that spread as well. There's a little bit of an arbitrage opportunity there. And this provides a great service to the entire market because if all the participants want to sell, Mike's going to be there to buy. And if all the participants want to buy, Mike's going to be there to sell. The problem that Michael Burry recognizes well is these shares are just little pieces of paper. They can trade back and forth in milliseconds. Farmland, not so much. It could take a year or two to sell a piece of farmland. So if the prices of farmland are plummeting in the primary market, Mike is going to look at the secondary market with prices going down, and he's going to say, boy, I don't know. I'm not really willing to buy these shares anymore because I don't know if I'm going to be able to liquidate that farmland once it gets out into the primary market. I might be stuck holding the bag. So market maker Mike says, nope, sorry guys, I'm out. All these people are left wanting to sell with no buyers whatsoever. What happens? It's just like the theater that Michael Burry references in the Bloomberg article. There's all these people that want to rush out, but the door is only this big. That means prices plummet and all these people lose massive amounts of money. Step number 4, Michael Burry's next concern, derivatives risk. Let's go right back to the Bloomberg article. Potentially making it worse will be the impossibility of unwinding the derivatives and naked buy-sell strategies used to help so many of these funds pseudo-match flows and prices each and every day. This fundamental concept is the same one that resulted in the market meltdowns in 2008. The best way to understand derivatives is it's a lot like a side bet. So we're going to insert yet another participant into the equation. This time, It's counterparty risk, Chris. So smart farmer Joe goes to Chris and he says, boy, this market, this farmland really looks overpriced. I will bet you $1 million that the farmland market is going to go down. And counterparty risk, Chris says, okay, fine, I'll take that bet. So Eddie sees that and he says, boy, this side bet would be great for our portfolio. That would add a lot of value. So Eddie buys the side bet from Joe. The problem with this is that side bet, although it may be worth $1 million to Eddie and Joe, it doesn't have any asset to back it up other than the promise of Chris. If the market tanks, credit markets freeze, and we go into a great financial crisis like we had in 2009, Chris is going to be wiped out. And even if Eddie wins the bet, he can't collect on that bet because Chris is broke. And this sends the shares of the ETF down even further. You can see that when I talk about financial engineering in a negative way, this is exactly what I'm talking about. Step number 5. What is my advice? Should you buy an ETF or not? Let's start with the positive features of an ETF. No homework, low fees, and over the long run, you're going to beat all of the active managers. In my opinion, that sounds a little too good to be true. And if something sounds too good to be true, usually it is too good to be true. Let's go back to the whiteboard and look at who these players or our participants actually were. Who was Farmer Joe? Any guesses? Warren Buffett. Who is ETF Eddie? Vanguard. Who was Farmer Fred that lost all of his money? The retail investor. Just like all these people out here that got stuck holding the bag when the market crashed. Counterparty risk, Chris? The investment banks. Deutsche, Goldman Sachs, pick your favorite one. So I'm not saying don't buy ETFs or index funds. What I am saying is don't buy ETFs or index funds unless you can analyze risk and understand the underlying asset and the value of that asset, as well as Farmer Joe and Warren Buffett. For more information like this, check out this content right here, and I will see you on the next video.